All right, everybody. Good afternoon, and welcome to episode number two of Distressed Deals Decoded, where real estate problems meet real solutions. I'm Patrick Butler with Asset Resolution Advisors, and today we're going to dive into more issues that most agents and investors walk away from and show you exactly how to turn these into more closings. So, what if the 50-year mortgage, we've all heard about it, what if the 50-year mortgage isn't a crazy idea, but in fact a potential solution for people who otherwise may be priced out of the market, the next step for affordability? And what happens when a homeowner with a 50-year mortgage or a 30-year mortgage in today's marketplace hits a hardship? No equity, no room, no options. There's gold in them, Nar Hills, folks. So, why this topic matters for agents, for investors, and troubled homeowners is because we are in that space right now. We're seeing defaults happening. Before I go on, I would like to introduce my two co hosts, Mr. Juan Nicasio, Mr. Acquisition. Juan, please say hi to everybody.
Hello, everyone. Thank you for chiming in here. I'm happy to be able to provide you guys some real value and help you guys navigate through what this market is demanding and things that you should be training on.
Nice. And Mr. Steven Schiller, whom I lovingly refer to as our reformed loan servicer. Steve is the brains of the operations. Steve, go ahead and say hi to the crew.
Hello, everybody. Looking forward to talking about this topic. I think it's going to be interesting.
Nice. So, Juan, why don't you set the stage for us? Why is this topic even important today?
Yeah, let's get into it. Let's talk about a couple things that we're gonna cover. So we're gonna go ahead and clarify why the 50-year mortgages are being discussed. We're gonna explain the economic forces behind the longer amortization, and then break down the risks profile for homeowners, especially early hardship scenarios. We're gonna discuss the implications for loss mitigation, short sales, and distressed property professionals.
Nice. So, Steve, you've been a loan servicer and, in fact, the default loan servicer for most of your professional career. Why are we even talking about 50-year mortgages? Aren't 30-year mortgages enough?
Yeah, the 50-year mortgage, was recently brought up by the administration as a way to deal with housing affordability. Um, Based on the factors out there right now, there's an estimated shortage of about 4.7 million homes. The issue that the administration is trying to deal with is exactly that. But I think there's a little bit more of nuance to this than just, hey, we're missing 4.7 million homes, right? It's not as easy as just building the homes and throwing them on a plot of land and saying, here we go, we're good. There are a lot of production issues that were caused delays by COVID. But the bigger issue, which really came up, is the affordability part. You know, that basically when you look at affordability, depending on where you live, an affordable house is somewhere in the range of 180,000 to $350,000, which is a lot of money. And so the idea is how do we implement a 50-year mortgage so that it's amortized over a longer period of time to make that type of loan more affordable or something even a little bit higher. So that's really where this has started to come into play.
Got it. Now, we hear a lot of things. Everybody's freaking out about the 50-year loan. Well, back in the 1940s, we saw the 30-year loan come out, and everybody freaked out about that. Would you say this is kind of consistent with that same mindset?
Yeah, a little bit. I mean, I think there's some things that we're going to discuss here and get into it a little bit more. But I think some people really are concerned about, is this affordable? Can we do it? Does it work? Does it not work? So I think that it's worthy of a conversation at the very least.
All right. So there are some common concerns and misconceptions. Why don't we go through a couple of those that basically, before we get into the real crux of this, is why the distress space needs to focus on this. What are some common concerns and misconceptions that you see, Steve?
So first, I think everybody is going to worry about, whether the early default, right, is whether there's going to be enough equity in the houses to make this worthwhile. And basically, is this too much of a risk, right? We know that there's not as much equity. How a private mortgage insurer is going to deal with insuring these loans. Does the loan cost become more expensive? So that's one of the issues. The other thing that a lot of people are concerned about is right now the median average first time home buyer is 40 years old. 40.
Mm.
So if you take a 50-year mortgage, you're saying, oh my gosh, they're going to be 90 by the time they finish, right? So this is a
Well, you'll
really big
never you'll
concern.
never pay the loan off is one of the big deals.
Right. So people are saying, oh, this is never going to work. Well, here's the reality. The lifespan we've always last 30 years or so of a loan is about 7 years. Really, it's somewhere between 5 and 12 years. So from that standpoint, I don't think a 50-year mortgage is a bad idea because for the most part, loans usually pay off in that 5 to 12 year range. So from an affordability standpoint, it does make sense, especially knowing that these loans most likely will get paid off in the 7, 8, 10 year range.
Got it. So a couple other things that I hear all the time is, well, it really only lowers the monthly payment a little tiny bit, and you'll never pay the loan off, and you're paying way more in mortgage interest. So I'm going to go through some of the pluses on this thing. And while all of those concerns are true, in fact, with any loan, the first half of the mortgage payments are almost always interest. So your equity buildup from paying down the loan is nominal in any situation. Of course, the shorter the term of the loan, the faster every payment goes towards a little bit of principal. But we do see an opportunity with longer term mortgages of lowering monthly payments. So if we put the Ben Franklin sheet up there with the line down the middle for first time home buyers in particular, having slightly lower monthly payments is in the right direction. It helps. Secondly, if we add to that where it is in fact the case, tax deductions for mortgage interest. So that's another subset of real money that comes back into the pockets of the borrower. Stability in terms of your payments. Well, I'll tell you what, everybody that I know that's renting says rent prices are going through the roof. So with a fixed rate long-term loan, you definitely have stability of payment. So lower payments, however slight that may be, tax deductions, and stability. Whereas rents are going up oftentimes 5% per year. And then you've got the long-term appreciation of the property. Now, this, folks, is where home ownership and the American dream is really where it's at. If somebody purchased a $200,000 home, I'm using very simple mathematics here, not taking into account depreciation and replacement of systems and all that good stuff, but a $200,000 home that appreciates at 5% annually after 10 years would be worth $325,000 and change. That's $125,000 equity buildup that homeowner has, whereby if they were renting for 10 years, they may not see that. So we could go into all the mechanics and the minutia, but one, there's an
Yep.
issue here. There's a reality that people need to understand, and we see it all the time in the cycles of short sales when people get into peak housing prices. Can you cover some of these issues that we
And
see?
that there is, some of the main concerns, right, when it comes from a loss mitigation, reality, is the hardships, right? They typically hit early. Most people struggle within the first 3 to 5 years of homeownership. And again, talking about amortization and any loan, whether it be 20, 30, 50 year, they're front loaded with interest, right? So you're not really gaining a lot of equity in the first couple of years. If you bought the top of the market, well, then that kind of leaves you in a negative equity standpoint, right? And that's because of many reasons, right? Like so most people around that time frame, 3 to 5 years, they have a lot of changes in life, right? They have job losses, medical issues, death in the family, divorces, income reduction. We see a lot of that lately, and then raising consumer debt, right? Again, all problems that lead to no equity in the first couple of years. So, in the first few years of a 50-year mortgage, your amortization obviously is painfully slow because again, you're not building enough equity, and especially if you're on the wrong side of the market where we're at the peak, you have obviously reduced equity values or appreciation. And then the homeowner may be underwater or barely breaking even at the time of sale. So obviously refinancing almost impossible because the banks are not going to refinance your property if you don't have any equity, right? And then selling the property conventionally, very, very difficult because it may have to sit in the market for some time until someone either sees the value in purchasing it for, your asking price or a price in where you can at least break even, and your options are just limited at that point, right? Because by the time you pay agent commission and you pay closing costs plus any price reduction or concession, most homeowners don't have enough money to bring to the table at the time of closing. So this is where I struggle with the 50-year mortgage. I think from an investor standpoint, to help maybe create some sort of additional cash flow, it may work if they have a long horizon. But from a consumer standpoint, unless they're buying this product, 50-year mortgage, the right side of the market where there is where appreciation will basically out right perform the interest rate factor, it's kind of tough. That those are the
Yep.
problems that I see, and then loss mitigation has to get involved, and we go into the bankruptcy side of things, foreclosures, and distress assets, which is what we focus on here.
So that's a great segue. So I think you really nailed it. In fact, you said a couple of things that made me think of some loss mitigation terms. Difficult to refinance a loan that there's no equity and that you just got a mortgage on. And I think it's important, by the way, you mentioned that these issues oftentimes happen early on. Now, on average, 1 to 2% of loans nationwide go into default, and oftentimes it is from some early financial surprise. So can't refi. Well, there's a term in loss mitigation that we call the loan modification. And the loan modification is one example. Now let's talk about what do we do if we need to liquidate the property. So, Steve, what does this mean for some of the homeowners?
Yeah, I mean, a couple of things. First, I think Juan brought up some good points, and as he was talking, it all of a sudden triggered in me that the 50-year mortgage is just another way of spelling interest-only loans.
Sure.
You know,
Yes.
it's almost that reintroduction of that same concept. And to your point, Juan, I think it's great that there probably is a purpose for it with real estate investors, people who needed to for cash flow purposes, right? For the consumer, especially new homeowners, I agree 100%. I think it's going to be a difficult transaction. And it's just because of those hardships, right? It's going to be really hard to modify the loan. There's no wiggle room. You can't just, yeah, we could try to extend out the loan terms. You can try to lower interest rates, but we know that, that's very cyclical in the market, and you have to be really lucky that your interest rates fit the right mold for that mod. For that from that standpoint. So really, what it comes down to is, when people are buying that home, I mean, and they default on this, there are not many options other than really short sale for the most part, and it's just because of the time frame, right? You've got lowering values usually. You've got not much equity built up, and there's just too many factors. Very, very, very hard to overcome those factors, which poses an opportunity within the distressed asset world to do short sales.
No doubt about it. So I guess, from our standpoint here, and as we circle the wagons on this whole topic of conversation, real estate professionals, in particular with this topic, real estate agents, there are some immediate opportunities that we see out there all the time. In fact, if you look on the MLS, there is a subset of listings that are on the market for usually greater than 120, maybe even 150 days. And almost every single one of those, if you eyeball them, it's because they're priced out of the market. And one, it's based on something you said, like, okay, well, I bought this house a year and a half ago at peak. I owe a real estate commission. I've got some other monies that I need to pay. I need to sell it for 27% above fair market value in order for me to break even. So let's list it there. And lo and behold, there are these properties sitting on the market that will not sell under conventional circumstances. So they have to go through short sale or something else for the consumer if they want to get out of that deal. So this is where we have to get savvy as professionals. And in the loss mitigation space, that's where we find a lot of opportunity. So how this 50-year mortgage can change the landscape, or certainly how all of the metrics of today's marketplace, including just coming off the peak of the market, swinging from seller's market, superheated seller's market, into slightly buyer's market. Short sales back on the rise again, folks. We're in the space for 20 plus years. They haven't gone away. They just keep ebbing and flowing, and they're coming back hot and heavy, as are bankruptcies, because bankruptcy is usually the stopgap between I can't make my payments and going into foreclosure. So we've got a few opportunities and some takeaways here. So let's kind of round robin this a little bit, guys. As far as realtors are concerned, Juan, what are some of the takeaways that they should be looking at in this marketplace?
Well, they got to expect, lower equity sellers. So if the market continues to go in the direction that we are seeing from a data standpoint and from a day-to-day standpoint, me, myself as an investor, I do invest in marketing, and I do get a lot of inbound homeowners that are looking to sell property. And I'm seeing this day after day in where I can't particularly do much for the homeowner that is looking to break even or have a little bit of equity to walk away and maybe start over or move. So those sellers are increasing day by day. So what do you have to do there? You got to get educated on short sales because it's inevitable and the numbers are staggering and they continue to increase. So is bankruptcy sales, right? A lot of people have a misconception that there are no deals once a property is in bankruptcy, right? That's false. We have data that shows that there are still people that end up in this situation, homeowners, just due to lack of understanding and knowledge. Plus, of course, most of the attorneys that help process these bankruptcies, they don't really educate the homeowner on a lot of their options as far as their home. You have, lien negotiations that you can educate yourself on, distressed properties workflow, and then position yourself as that solution agent or investor to be able to help these homeowners that are currently stuck. They don't know their options. They don't study this. They sign their life away at the time of closing, not knowing what their avenues are in case that things are not as planned, right? Because life does throw you for a wrinkle sometimes. For the investors, you're going to be able to find, because again, I'm doing this every single day. I get a lot of off market deals, homeowners that are not on the market and they're going through the situation and trying to figure out how they can get out of their property. The off market opportunities are increasing drastically month after month. Early hardship cases create motivated sellers, right? So it's in these last couple of months, I will say the last 12 to 15 months, the conversations that I've had with homeowners, and I've been doing this for 11 years, have drastically changed from an entitled, I want this much and you pay, this amount of dollar and 0 day inspection and you buy it as is and you're gonna give me above, to like, oh, I'll bring some money to the table. I just need to get out of this. What options are there? The conversation is completely different because they're truly motivated. They're understanding in the position that they're in. They don't have a lot of leverage, right? And then potential for long-term rentals, as I mentioned earlier, to build that appreciation, right? In those type of deals. And of course, the 50-year mortgages can potentially help with that. But this is the education that folks need to dive into as we go into this marketplace, right? So longer mortgage terms equal more experienced resolution partners is basically what the biggest takeaway here is. You got to get in the education. You got to know how to, work these type of deals because there's going to be an abundance amount of opportunity as we continue to go on this market shift.
No doubt. So I'm going to kind of weave in a couple of brief commercial messages here, but Steve Schiller. So Juan said a mouthful there. There's a lot to unpack, but I'm a real estate agent. I not an expert at short sales and I'm running into them over and over and over again. Should I just stay focused on my niche, whether it's first-time home buyers or working with investors? Should I just throw those opportunities in the garbage, or is there a way for me to kind of get the best of both worlds? Can I monetize on these and not know much about the process?
Absolutely, there's a way to monetize off of it, and specifically, one of the things we've created in school that we will send more information out is a way for agents to one understand the process, and go through what a short sale is and what are the necessary steps for it. There are some agents out there, especially first time, who they want to dig in, right? They want to learn how to do it. They want to go through the process, work with the servicers, work with whoever, and get the deals done. We're, as part of our school, we're going to educate those who want to learn about it, how to do it, and the mechanics of that process, because it is a little bit different, right? You have certain things of the loan and what you need to do in order to get it to closing, and so that's something that we teach and we talk and we support about. On the opposite side of it, if you want to monetize it and not do all the work, right? We hear from a lot of agents, look, I just like the people person part of this, right? I like finding the homeowners. I like talking to them. I like going through and just listing the property and handling that piece. I don't want to do all the paperwork that's necessary. I don't want to talk to the banks. I don't understand all the distressed part of it. I don't want to learn it. I just want to do just the front end piece. How could I do that? That's where asset resolution comes in, and we can actually work the case with you, work the property with you through the entire process. So either way really can work for an agent, one who's experienced, one who's new at it, can learn the process on their own, or they can partner with us and we can do the actual work itself. So from
Yeah.
that standpoint, yeah, there's ways to monetize it either way.
Yeah, and
Yeah,
Juan, you
from the
brought up
investor.
bankruptcy
Sorry.
properties. Oh, I'm sorry, go ahead.
No, I was going to say, even from the investor standpoint, there's plenty of deals that I brought to you that have been very, very difficult for me to get through from a title aspect, that you have helped as well, not only from a short sale, but other, encumbrances, liens and violations and things of that nature that your company has been able to help so that I can get it to the finish line as an investor. Because I'm heavily invested in marketing. I'm heavily invested in EMDs. I'm heavily invested in the seller. And so getting to the closing table and not be able to process it from a title standpoint, from a lien standpoint, that's very difficult. And I'm not an expert at that, right? So a company like yours really has helped me in the last 12 months to try to get those things over the hill. It's very important to note.
Yep. And Juan, you brought up bankruptcy earlier as well, and we'd be remiss if we didn't bring that up. But Steve and I spent the better part of the last 14 years doing nothing but short sales and bankruptcy, developing programs for the federal trustees themselves who really didn't have a handle on how to get this done. So, yes, the education spans from either how to do it all yourself, all the intricacies and all the brain damage, or how to work with an outsourced company like Asset Resolution Advisors and still make your money. So we won't get into all of the details on that today, but we do have a couple of really exciting things. We've got our Distressed Deals weekly update where we'll go through one particular deal that had a lot of hair on it and how we were able to circumnavigate the issues and create a winning proposition for everybody. So every week we're doing this particular video podcast. We encourage you to join us, and more importantly, we'll have these posted in our school community and hopefully on YouTube very shortly where you can access this. But within the school community, we do have some very special programs just for members. So we do encourage you to visit us at school.com and look for Asset Resolution Advisors. All right. So if you're working a short sale, a bankruptcy sale, you have questions about these things that you may not know which direction to turn, you've got judgments on properties or any complicated issues, we are your one-stop shop. This is our commercial message for you. Reach out to us, folks. We're very easy to find. We're super easy to talk to. Our website is assetres.com. You can fill out a form and chat with us at any time. So, gentlemen, unless there's anything else you want to cover for the good of the order, I think we can go ahead and let these folks get on to the rest of their day. Any thoughts?
No, thank you guys for tuning in. I hope this was very helpful. Please don't be fearful of these distressed assets. You got a resource in order to navigate it. So thank you so much, guys. Have yourself a
Sweet.
wonderful day.
Say
Thank
goodbye, everybody.
you.